but I think it will not be out of place. Because like I said, from bullet 1 to the last, you are not a PIE. The only thing that made you a PIE is the last bullet. Inform FRC so that we can at least on record watch you over the next maybe 3 years. That we are doing already. That we are doing already. Because we also know that like here we have preparers, we have practitioners. Some of us interface with us. Some of us, good thing, inform our clients that look, you are a PIA now. Of course, you are correct. But some of the clients quickly write to say, look, we are just entering now, what do you advise? Of course, we know the advice that we'll give to you, but like I'm saying, it is better to inform us because by, call it definition, you're already a PIA. Next year you can go off, no problem. But of course, nobody wants to be bringing you in, taking you out, bringing you in, taking you out. But then we need to be able to manage that very successfully. So that's all about our new definition of PIE. All these other portions, registration of professionals, have told us that is one key thing. When we're talking about oversight, we talked of PIE, and then we said professional. That is why many of us here, and I want to believe everybody across board here, has registered with Financial Reporting Council, because it's either you are the one signing or you will sign in the future. Why don't you prepare for it? Or you are the one signing currently in your various organizations, whether private or public, you are expected to register. Why? We want to be able to have interface with you. And like I said, the FRC Act in that section 7 actually defined who must sign. It talked about the CEO and of course the CFO. Look, I have qualified XYZ account. Of course, the Act talks about giving reasons why the qualification was done and all of that. And then of course, we normally would have interface with the entity, in fact, with the auditor and the entity. Why do we do this? Is to be clear about the reasons for the qualification, but we do not, as a matter of course, we do not insist that the opinion be changed. It is the auditor's opinion, it remains their opinion. But then if in the course of our interface, the auditor feels otherwise, let me give a quick example. One of these years, we had such from the auditor, and what was the reason? There was a change in the auditor, so to speak, between one and the other. And somehow, for reasons which I also had a little stint as an auditor, the new one did not shake hands well with the old one, or the entity did not do the behind the scene interface very well. So the old one refused to release opening balances. So the new one did the audit, at least now from January to December, he can do the audit. But of course, he needs the team from the first time. So he said, well, I've done my own, but I don't trust this figure again because the opening balances I don't have. That was a clear qualification matter. PIEs, FRC is doing that. For auditors who audit non-PIEs, we have entered into a proper working relationship with the PAOs to support us in that regard. So all of the sections that were put out there, please find time to look at them. There are things that bear upon financial reporting generally. The other, I had said, each time we are looking at financial statement, we are looking at them across board. What did the FRC Act provide for? What did other acts, especially for financial services that as we know it, or for those who are regulated, what do they provide as far as their financial reporting and financial accounting and related matters are concerned? If for any reason there is a conflict, and I'm using those words, guidedly as it were, if there is a conflict between the provisions of any of those acts and the Financial Reporting Council's Act on anything that has to do with financial reporting, please, the provisions of the FRC Act will automatically prevail. Right in my head, I can't give a clear example now, but I'm sure over time, especially when amendments are being done, if there are areas that controversy exists, of course, they are already being aligned. But remember that we are not talking of prudential matters. And when we say prudential matters, for all of these regulatory bodies, there are things that are of importance to them. Section 55 talks about our process. Is FRC a standard setter? No, I think I've answered that. And then 59, which is what I'm talking about now, has to do with, this is just something that we know already, the roadmap to our adoption. When we came up with this, that removed us from direct standings, a standard setter jurisdiction. We became a quasi-standard taker. Why I use the word quasi is so at least we still interface with the entire process by sending in our views. But of course, all of these timelines, I'm sure all of us here we are used to. Private sector started 2012, stretched as far as 2014 for SMEs. Public sector was auditors starting from Rule 10, or I think starting from Rule 9, when we now had to key into the new reporting framework, as it were, for audit opinion. We are no longer, it's no longer just that one pager that we normally used to do. Now there are certain expectations, and that came up, and then we quickly pull out Rule 9 to say, look, this has become of importance, and we should, as auditors and as practitioners, take a cue. Rule 10 has to do with audit committee. We are now saying all members of the audit committee, so it doesn't just become a tea party and an umbrella carrying team. You should register with us, and we want to know in terms of how the entity is interested in your group, so that you can speak to financial audit, and monitor applicable regulations. We give heavy weight to our rules. We give heavy weight to provisions of the Act that bear upon financial reporting. Why? Because those ones are not principles based. I'm sure anything in the Act and anything that you have called rule already is a rule. There's no principles based rule. The only principles based thing that we all apply is our standards. And that is why we even have some levels of understanding that because we are all learning, and thank God we are operating a principles-based standard.
So your opinion about that matter, whether it will be a success or not. If it's going to be a success, we don't need any form of provision. Why? Because whatever case you are going to win, damages will not be paid. But if there's a likelihood that you're going to lose that case, then you have two scenarios. Scenario one, if we are losing, do you have an idea of the likely damage that we are going to pay? If you do, put that in a report to us. Based on your idea, as accountants will go straight into the financial statement and make a provision in line with IAS 37.
Those who are regulated, what do they provide as far as their financial reporting and financial accounting and related matters are concerned? If for any reason there is a conflict, and I'm using those words, guidedly as it were, if there is a conflict between the provisions of any of those acts and the Financial Reporting Council's Act on anything that has to do with financial reporting, please, the provisions of the FRC Act will automatically of your own specific instance and instances of that nature, because you are expected to have just one number. So if you have instances of that, please, you can interface with any of us or let us have that information and we'll correct it very quickly. Thank you.
Discuss how this revenue is recognized, how this revenue is measured, how do you present it? When you earn revenue, how do you present when this revenue is earned? So, It's as a result of this that FRC 47 came to being. Standard development. We adopt the international standard, but when there are exposure drafts like this, FRC picks it and then reaches out to the stakeholders concerned around that standard that is about to be issued. We get feedback if there is a misjudgment in revenue recognition. For example, you're supposed to recognize 50 million in revenue this year, and then next year recognize maybe 30 million. It's 10 years. As long as the work spills like that, you will continue to appraise your obligation on that contract before recognizing your revenue. So it's important to know when revenue has been earned. It's very, very important. If you can't get that, then you've missed a whole lot of things. You have to calculate the risk attached to the remaining revenue. And that risk, of course, you must account for it. So, apart from that, in FRC 47, you now have what we call variable concentration constraint and performance obligation. These are central. The example of the contractor, I think in Nigeria there's something for those people. There's something they call varying of contract. Variation. Thank you. These are the length. Thank you. So, during variation.
Yes, sir. So I can collect your number and send it to you.
We find out that
Thank you.
the contract then covered by FRC 47. Leases, insurance contract, and financial instrument. These are covered by other FRC standards. For example, a financial guarantee is not revenue under FRC 47. That's what's financial guarantee? Benefit or potential
Yes, I registered, but when I was registered, they didn't see my
which represents an increase in net asset other than increase relating to contribution from the owner. So what I'm trying to say here is an item as revenue or not to. So what is a binding arrangement? In the private sector, you have what they call contract, right? You sign a contract, supply me this or supply me that, give me that or this. But in the public sector, we don't use contract. We use what? Binding arrangement. So it's still the same thing. So when I talk about binding arrangement, just see it as a contract. Money there, they didn't say anything. So whether that entity uses the money or not, it doesn't concern the government, because we're not specific on what we say they should do. You just give them money. That is not enforceable. Some people, when they receive grants, they may not know whether this grant is supposed to go to FRC 9 or FRC 23. That is one of the things that FRC 47 has come to address. So, if funding is unconditional, the donor agency, for example, they come to a community and say, this community is lacking so many, right? Yes. Because since 2016, it's 10 years. We should have at least adopted it. I know if all of the following criteria are met, all, not if any, for you to say this is a binding arrangement, these things must be present. If you enter into a binding arrangement, you treat that binding arrangement as a standalone. If the same entity is giving you another contract or you're entering into another binding obligation, you treat that one as a standalone. But if they have similar characteristics and they are done within the same period, then you can treat it as a combined binding arrangement. A binding arrangement. If the modification is negligible, it does not affect the previous binding arrangement. You can just adjust the price. But if that modification creates another contract or arrangement entirely, then you can either end this and start a new one, or you for every binding arrangement, you must be able to recognize that this arrangement is a standalone. And how will you recognize that? If, for example, you want to buy, you entered into a contract to buy a generator. If that generator can be used without any other thing, you don't need any other thing. Once you bring it, you can use it. Then that is a distinct arrangement on its own. But if you cannot, that means this one will be an input to another one. So, consideration. In the transaction consideration, when you say, okay, this is the amount for what we're entering into, you must take into cognizance if there is variable consideration. If at the end of the day something will happen, maybe there's a discount or they tell you perform this, I'll give you this. If that exists, you must take it into consideration. You must also take into consideration constraining estimates. Not dwell on it. So there's a difference between revenue and transfer. Revenue is I give you something, I earn something.
Yes.
That's revenue.
That's commercial nature.
For the money you're giving to me, I am giving something in return. That is revenue. In transfer, it's totally different. In transfer is I am giving you something, but I am not expecting anything directly from you. Rather, I expect you to use the money I gave you to do something for a company, an entity, or a group of people.
Or a community.
Do you understand it?
Yes.
Government gives you the money. You're not giving government anything directly back. It's also based on accrual basis of accounting. The effective date is what? 1st January. So for all 2026 financial statements, you must apply this standard in accounting for transfer expenses as defined in this standard, including capital transfer. If you check this, it does not apply to them. When you come to this standard, these items, they have their individual standard. It also does not apply to share-based payment or income tax. From a binding arrangement with specification, say, okay, out of 1 million,
this is your share.
5% is your administrative cost. Do you understand it? If that 5% that's administrative cost, when you remove it, the one you're owing government is 95%. 5% of administrative cost can be recognized as your revenue. Entity right from the transfer arrangement is extinguished. Let me explain all of this grammar. When an entity transfers an asset, whether money, that transfer is held as transfer asset because they've not performed the obligation. Once they perform the obligation, that transfer asset will be the for a transfer. You don't want to bring it in the book as an asset. How do you do that? Once you transfer some fund And of course, remember, we are talking of the end of the year. If it's within the year, no problem. But once it gets to the end of the year, you want to prepare a financial statement and recognize it. You will check. If I've not transferred money and an obligation has been fulfilled on my behalf, that obligation goes straight to what? Expense. Do you understand? I will not recognize that asset. I will still carry it as a transfer right asset until that obligation is fulfilled before I can recognize it. Do you understand? The difference with enforceability. For arrangement to be binding, it must be enforceable. We all know that. In determining whether arrangement is enforceable, the entity considers substance rather than legal form arrangement. We've discussed a lot about binding, arrangement, and enforceability. So for unsatisfied binding arrangement, just like we discussed in revenue, the SARS 47, if an entity is supposed to transfer money to another entity,
is only for government
entity A is supposed to transfer money to entity B. And entity B is supposed to fulfill some obligation because it's a binding arrangement. At the end of the year, entity B did not fulfill any obligation to say, oh, I fulfilled the obligation, you're not owing me. Entity A did not transfer money and say, oh, help me do this assignment. The two of them, do we recognize anything? No. Nothing. If there's no binding arrangement, and I ask, an entity requires another entity to do something or to fulfill an obligation. Mind you, there's no binding arrangement. So, at the point where you're asking another entity to fulfill, at that point, what you would do is no longer recognizing right or liability. What you will recognize is what? Provision. Subsequently measured using best estimate. And what you measure using best estimate is provision. So you use best estimate to measure the amount that you paid. And when I say best estimate, you calculate whether there was a variable consideration, whether there were rates. All those things will be taken into consideration when you're measuring the amount you paid. When an entity recognizes an expense at the time it ceases to control the resources, the entity shall measure the expense at the carrying amount of transferred resources. Binding arrangement. Let me just explain quickly. I've already talked about it. In binding arrangement, when a transfer is made and the obligation is yet to be fulfilled, what do you call that? Transfer right asset. Transfer right asset. And now when we enter into a binding arrangement and the other person fulfills before we did, what do we call it? Transfer obligation. I say, okay, render this service, all right? And I paid 10,000 naira. The person has not, you know, it is bank that I used to pay. I paid cash. At the end of the year, that person has not fulfilled his own side of the obligation.
So it's an asset.
I will not go and say, I debited cash. I won't leave it like that. I will now recognize that cash that I used and recognize another asset, which is transfer right asset. The transfer entity shall recognize expenses when a transfer right is recognized. And when is a transfer right recognized? If I have a transfer right, that's because the other party has not fulfilled, right?
Yes.
That's why I have a transfer right. Yes. But once the other party fulfills, what do? I transfer the transfer right to expense. Yes. Is it not?
Yes.
They recognize it. Yes. Then, when a transfer obligation liability is recognized, if at the end of the year, I enter the contract, or before the end of the year, the person has supplied, and I have not paid.
Obligation.
It's an obligation, right?
Yes, because you are owing the person.
What if before the end of the year, as government where may I be, and they pay everybody before the end of the year, and I now say, oh, this man we are owing you.
You're expensive.
What will I do?
Yeah,
I will transfer that liability into what?
Expense.
Accrued expenses.
Okay.
Mind you, you're carrying that item as transfer right asset. When you now receive cash, you will not treat that cash as to extinguish that right asset. What you will do is recognize the cash not under IPSAS 48 again, because you're receiving cash. Where will it go to? Cash is what? Cash is a financial instrument. Do you understand?
Yeah.
If there's no fulfillment of the obligation and cash is paid back, when you are accounting for the receipt of that cash, you don't use IPSAS 48. You use what? IPSAS 41, financial instrument. That will be, you bring in the cash into your bank and then extinguish this right. So transfer consideration is total carrying amount of the resources, of course, that you've used to transfer to the person. But in considering the transaction consideration, you also have to check if there are variable consideration, things that can affect it. Then you recognize it in the consideration, and then you measure accordingly. When an entity transfers resources to a transfer recipient, prior to the transfer recipient starting to satisfy its obligation, the entity shall, at recognition, measure the resulting transfer right asset and the total carrying amount of the resources which have been transferred. The entity has not yet transferred the resources as required by the binding arrangement. The entity measures its transfer obligation liability and the total carrying amount of the resources which the entity is obliged to transfer in accordance with. So, it could be the other way. The man has fulfilled his obligation. At the end of the year, I need to measure what I'm owing him. Whatever is the carrying value, what that man has stated, this is the amount I sent this thing for. Notwithstanding what was there initially, or in the agreement initially, it is what he has stated that you put as the carrying amount, because that is what you're going to pay him. Times is rebate, discount, fulfilling the obligation earlier than expected. They can say yes, okay, take this. It can also result from finance cost. If it's a transaction that will run over a period of time, they can say, okay, we need to charge finance costs on it. All those will affect the consideration. So, in allocating transfer consideration, most times treat each transaction as a standalone. It's only when that transaction cannot be seen as a standalone, maybe it's an input into another transaction, that you treat them together. His own part of the obligation. And if you like, carry on from up, flog and from down, nothing will come out. Or if the worst happen and the person who is in charge or who entered into that transaction is no more, will you carry it in your book indefinitely? No. It's an impairment. And when you want to impair it, you don't impair using IPSAS 48. You impair using IPSAS 21. IPSAS 21 talk of impairment of non-cash generating assets. With presentation requirement for provision in paragraph 88, minimum line item. Minimum line item. Paragraph 94, sub-classification of items, and 107, information on the statement of financial performance. So what are we saying? IPSAS 1 makes it mandatory. If you have provision should be a line item. You don't add provision to any other thing. And then you can also have sub-classifications. Under provision, you can have different provisions under. But in your statement of financial performance, it's one line item. So IPSAS 1 recognizes provision, and any provision resulting from transfer expenses is treated in line with IPSAS 1 when it comes to presentation. For transfer expenses for transactions with binding arrangement, when only one party to the binding arrangement has performed and the other party have yet to perform, an entity shall present the binding arrangement in the statement of financial position as what? As a transfer right asset or transfer obligation liability based on the guidance in paragraph 23 to 25. So, to enable users of financial statement to understand the nature, amount, timing, uncertainty of expenses and cash flows arising from transfer transactions. So we expect you to tell us this transfer transaction is with a binding arrangement. These ones are without binding arrangement. All those should be stated in your financial statement. You apply this standard IPSAS 47 prospectively, but for transfer, you can apply both prospectively and retrospectively. Do you understand?
Because there might be some transactions that are still
prospective to transfer occurring on or after the date of initial application arising from transaction binding with and without binding arrangement, or retrospectively to each prior reporting period presented in accordance with IPSAS 3. So, if you do it prospectively, do you need to change your accounting policy?
Yes.
If you do it prospectively?
Yes, going forward, yes.
Do you need to change your accounting policy?
Yes.
The only thing I expect is to do what? Update your accounting policy to reflect IPSAS 48, right?
Yes.
Well, if you do it retrospectively, that means you're already you're going to change your accounting policy because you're taking it back to the transaction that have been concluded. So in that case, you go back to IPSAS 3 to see what accounting policies, change in accounting estimate and errors is saying regarding the policy that you're changing.